If you're new to investing and not sure where to start, you're in good company. Today, I'm going to walk you through the basics step by step so you can start building long-term wealth with confidence. Let's keep it simple, clear, and actionable. Sound good? Let's dive in. So here's the thing, saving money is important. But if you're just letting it sit in a regular savings account, it's probably losing value over time, thanks to inflation. Historically, inflation averages around 2 to 3% a year. That means your money needs to grow just to keep up, and that's where investing comes in. When you invest, you're giving your money the opportunity to grow faster than inflation, especially if you give it time to compound. That's the key. If you want to learn more about compound interest, you can find a link to a video in the description that will teach you all about it. Before you even look at investment options, ask yourself, what am I investing for? Is it retirement? A new home? Your kid's college fund? Your goal tells you two things: how long your money can stay invested and how much risk you might be able to take. The longer your timeline, the more room you usually have to ride out the market's ups and downs. All investing comes with some risk. Stocks go up and down. Bonds can too. That's just part of the deal. But here's what people often miss. Risk isn't just about volatility. It's about the chance of not reaching your goals. If you avoid all risk, you might also avoid the growth you need. The goal is to find the right amount of risk for you. Younger investors, you may want to lean more aggressive. Close to retirement, you'll probably want to be more stable. You've probably heard the phrase, don't put all your eggs in one basket. That's diversification. It means spreading your money across different types of investments: stocks, bonds, real estate, even different industries or countries. Why? Because if one part of your portfolio has a bad day or a bad year, the others may help balance it out. Diversification helps smooth out the ride. What you invest in matters, but where you invest matters too, especially when it comes to taxes and long-term growth. Here are a few key account types to know. First, the 401k. If your employer offers one, especially with a match, this is a no-brainer. It's basically free money for your retirement, so take it. Then there's the traditional IRA. This one gives you tax-deferred growth, which means your investments can grow without being taxed each year. Depending on your income, you might even get a tax deduction when you contribute. Next, the Roth IRA. This one's kind of the opposite. You pay taxes up front, but then your money grows tax-free. And when you retire, no taxes on your withdrawal. That can be a huge win later on. Now, if you're looking for flexibility, consider a brokerage account. You can invest in just about anything, and there are no contribution limits. The trade-off? You'll pay taxes on any gains and income along the way. And finally, the HSA or health savings account. If you have a high deductible health plan, this is a hidden gem. You get triple tax benefits. Contributions are tax deductible, the money grows tax-free, and if you use it for medical expenses, withdrawals are tax-free too. It's like a supercharged savings account for healthcare. Most people benefit from using a mix. We help clients choose the right combo based on their goals. Investing isn't about chasing the next hot stock or reacting to headlines. It's about staying disciplined, even when the market gets bumpy. Let's talk about a few simple habits that can really move the needle when it comes to building long-term wealth. These aren't flashy. They're not about timing the market or chasing the latest trend, but they work. First, set up automatic contributions. Just letting money flow into your investment accounts consistently without having to think about it can be one of the most powerful moves you make. Next, think about dollar cost averaging. That just means investing a set amount at regular intervals. It takes the emotion out of investing and helps smooth out the ride, especially when markets are bouncing around. Every now and then, say once or twice a year, rebalance your portfolio. It's like giving your investments a tune-up. You're making sure your mix of stocks, bonds, and other assets still lines up with your goals and risk tolerance. And here's the big one. Stay focused on the long term. It's easy to get caught up in the headlines or short-term noise, but the people who tend to do best are the ones who stay consistent and patient. Remember, market ups and downs are totally normal. What matters most is that you keep showing up. It's consistency over time that builds real wealth. If you're just getting started with investing, here's some good news. You don't have to overcomplicate it. Seriously, there are a few simple, smart places to begin that don't require you to be a financial expert. First up, index funds. These are super popular because they track major markets like the S&P 500. That means you're getting broad exposure to a lot of top companies all in one fund. And bonus, they're usually low cost, which helps your money grow further over time. Next, there are ETFs, or exchange traded funds. They work a lot like index funds, but with a bit more flexibility because they trade like individual stocks. So you get simplicity and control. And finally, if you're investing through a 401k, you've probably seen target date funds. These are built to adjust automatically as you get closer to retirement, starting off with more growth-oriented investments and then gradually shifting to lower risk ones as your retirement date approaches. So if you're new to this, start simple. These three options are designed to make investing easier, not harder. Once you get comfortable, you can explore more options, maybe even individual stocks or other strategies with guidance. All right, let's wrap this up with a few quick things to avoid. These are the pitfalls that can trip people up, especially early on. First, don't wait too long to start. Time is your best friend when it comes to investing. Even small amounts can grow into something big if you just give them enough runway. Next, don't try to time the market. No one, and I mean no one, gets it right consistently. Focus on time in the market, not timing the market. Another note, don't put too much into one stock. Going all in on one stock might sound exciting, but it's risky. Diversification protects you from surprises. Also, don't forget about taxes. Whether it's capital gains or how your accounts are structured, taxes can eat into your returns if you're not paying attention. And finally, avoid emotional decisions. The market goes up, it goes down. It's part of the deal. Making impulsive moves usually leads to regret. Bottom line, start early, stay consistent, and keep learning. That's where the real magic happens. You don't need to have it all figured out. Just take the first step and keep going. At Trajan Wealth, we're here to help you build a plan that works for your life and your future. Thanks for watching, and don't forget to subscribe for more insights like this.